Fibonacci ratios are powerful universal patterns that show up everywhere in art, nature, even in financial markets. Smart traders use this Fibonacci tool to find high probability trade setup, but people always get it wrong. In this video, I'll show you how to use this tool to gain an edge in the market. What is the theory behind Fibonacci? Fibonacci is a sequence of numbers that creates ratios describing the natural proportion of things in the universe. The ratio arises from the following number series, from 0 to 1 to 1 to 2 to 3 to 5 to 8, 13, 21, 34, 55, and so on. It was discovered by a famous Italian mathematician known as Leonardo Fibonacci Pisa. The magic of Fibonacci numbers. If you calculate each petal on a flower, you discover that you get a Fibonacci number. If you also calculate the bones in your fingers, you discover you eventually get a Fibonacci number. Even down to the Egyptian pyramid, the sequence keeps going on and on and on. It is a spiral pattern that shows and repeats itself in various life forms. Now, let's say we square each and every number here. 1 square equals to 1. 1 square equals to 1 as well. 2 square now equals to 4. And 3 square equals to 9. 5 square equals to 25, and so on. The pattern repeats. Now, if you add each and every number accordingly, let's say we add 1 plus 1, we get 2. We add 1 plus 4, we're going to get 5. We add 4 plus 9, we're getting 13. And we add 9 plus 25, we get us 34. And this pattern keeps repeating itself. This is not magic. It's a pattern that keeps repeating itself. Now, if you measure the ratio of any number succeedingly, let's say you measure 34 divided by 55, you definitely get a 0.618, which is the golden ratio. Fibonacci levels are effective because they reflect human psychology and market behavior. Traders and investors often use this mathematical derived level, creating self-fulfilling support and resistance zone, the 61.8% region, which is the golden ratio. The Fibonacci levels, we have the 0.3 region, we have the 0.5 level, we have the 0.618 level, we also have the 0.7 retracement level, but we tend to only focus on the 0.5 and the 0.68 because it's a golden zone. How to use it in trading? The Fib tool works effectively with trend trading. Trend trading consists of higher highs and higher lows, lower highs and lower lows, which brings about the direction in the market. Step 2, point of interest. After deriving the direction of the market, we will draw a Fibonacci tool with a support or a resistance zone which has a previous structure in and a chart pattern. Step 3, confirmation. We need a bullish or a bearish engulfing candle from this point of interest to confirm our trade. This is a spiral pattern that often appear on every time frame. Alright guys, welcome to my screen where I'll be showing you real life example of how the Fibonacci tool had worked in the past and how to implement this tool when you are trading. Well, as you all know, the tool is drawn from the lowest point in the market to the highest point to get a potential Fibonacci retracement, discount, premium, there are a lot of things people do call it. Then when we suddenly finally get that pullback for more push to the upside, that's the golden zone. That's the psychological level where traders like to take advantage of the market. I mean, if I did draw my Fib from here to here, you can see how easily I was able to pinpoint this point in the market, this 0.618, without even drawing the two. Just that very easy. Now there are other parts that people like to use, but like I do like to streamline my focus to just the 0.618 exactly. So I mean, it's very easy. We need to first find an impulse move to the upside or downside, maybe something like this, then a pullback, and a continuation. Now that is your Fibonacci region. This region where the market pulls back into for a very strong push to the downside is the precise area you are looking into get into the market. Now let me show you a real life example. I mean, we got an impulse move. You can definitely see this impulse move. I'm not trying to write text. This is Euro USD. This is on a monthly time frame. Imagine spotting a Fibonacci trend on a monthly time frame. It gives you a direction. It gives you a direction in which you'll be trading the market for a couple months. I mean, if I spot a Fibonacci on a monthly time frame, I'm looking to trade into that direction for minimum 6 months. Minimum 6 months. Now let's say we have an impulse move to the downside. Like I mentioned, the market definitely pulls back into a fib region. For here, it might sound like a breakout, retest, and whatsoever, but like the market pull back here, then give us another move and did a double bottom, double top. After doing this chart pattern, the market sold all the way down, all the way to the extension. Now let me show you what I mean by that. Join my fib from here to here. Can you see? We came into this region, which is serving as a resistance, created a double top, and now the market gave us an impulse move to the downside. It's just that easy to explain. It's just that very easy. Now, what I was trying to explain earlier on in the video is I just don't use the Fibonacci blindly. I like to see confluences in the Fibonacci. I like to see a trend. I like to see chart pattern formation. I also like to see a self-fulfilling support or resistance in that region with a rejection which will solidify and confirm my entry into that trade. Very simple. Very, very simple. All the way to the Fibonacci extension. Now, this is Euro USD. I can also show you on a weekly time frame that even when Euro USD decided to start staging a rebound and start buying, we had this impulse move to the upside. We kept ranging for like 2 years. I remember trading this market and bro, trust me, you do not want to trade this. The market kept ranging and ranging and ranging, but eventually we gave an impulse move back into this region before we started blasting out. Very simple. Draw my Fibonacci from the extent from the last point in the market, which is the lowest point, to the highest point in the market. I'm very sure you can see how this market came out of the range it was in, came out of this range and ran into the Fibonacci region, which is the 0.68 before it started blasting out. No brainer. I already started calling the markets. I already started calling long position for Euro USD. We sold, we bought all the way here, came here, range. We finally did a liquidity sweep. People call it so many things, but like I feel like we came into the Fibonacci to really test into that 0.61 Fibonacci, and we started blasting out all the way to the Fibonacci extension. Now I can tell you for free that this market is coming all the way to this support region, but like that's not what I'm here to talk about today. I'm here to talk about the market's behavior, how drastic it is, the market comes into a Fibonacci region and start buying. I can tell you, this is by far the most important tool in trading. I mean, I just give you two examples of a selling market and a buying market. I can even scale down to a lower time frame and look for a day time frame impulse move to the upside that can guarantee a Fibonacci move for you to play around. Even Fibonacci works on a 1 hour time frame, but like, I mean, if I can spot a direction on a monthly time frame indicating I'm going to be buying for the next 4 months, 6 months, I'd rather want to place my trade there, so because I know I can keep scaling into that position for the next 6 months, rather than getting into a Fibonacci move on a 1 hour time frame, knowing that okay, this move can only happen for like the next 3 hours. And I mean, I can definitely make profit off of that, but like, I mean, 3 hours profit to 6 months long margin, you can't compare that. There's no way you can compare that. Now let's say this was a range. I don't really want to give you an example in this range, but like, let's just eat it. Let's just eat it. Do you get? Now we came here, we pull into this region, and you see the way we've danced around here and came all the way here. Eventually we still sold into this region, regardless of this fib not playing out fully. You can definitely see the reactions off of this region. We have a shoulder here, we have an head, we have another shoulder. Chart pattern formation, like I said, I like to see chart pattern formations in a Fibonacci, and this is on a daily time frame. So after all of this, the market gave us head here, it gave us the shoulder here, which was the right shoulder, then it gave us the head and the left shoulder. Then the market started blasting out all the way. Now I'll even show you again that when this market started blasting out, it gave us another chart pattern, because yeah, this is our Fibonacci. We already understand that this is the Fibonacci region here, right? Now if I draw my fib from this low in the market, this low that gave us triple bottom, let me show you on a 4 hours time frame, you probably see well. All right, there's this low in the market that gave us triple bottom. I know you can see what I'm trying to explain to you. This, mind you, this is the right shoulder. Now we finally, let me just delete that. Now we finally decided to give us a shoulder, and the market started blasting all the way here. I'll tell you that it was so easy that the market came back to fulfill a Fibonacci region here before it started blasting out all the way to the upside. Now let me show you. Triple bottom, draw my fib, triple bottom, draw my Fibonacci all the way to the high. Can you see? The market just pulled back into this Fibonacci region 0.168 and give us all this move. Can you see this sporadical move coming out of here? Now we also have a counter trend playing out here. We have multiple bottoms. If I scale down to a 1 hour time frame, you see multiple rejections from here, and finally we got the engulfing candle. This was a no-brainer trade. I mean, just imagine you had a trade here somewhere here and you were holding all the way here. And this is on the 4 hours time frame. This will probably play out for a couple days, but like, I'm just saying, spotting trades like this on a 4 hours time frame is fine. Spotting it even on a 15 minutes time frame is very, very fine. But once you can spot it on a bigger time frame, bro, you're going to be a god in this market. Very easy. I can see an impulsive move to the upside. Let me explain again. Impulsive move. All right. A pullback into this region, and can you see this? Can you just see this? Like, bro, this is all you need in the market. Understanding the direction of this market, this is all you need. Very simple. Sporadic move pull back into a discount or premium region, and a blast to the upside. Now, let me even scale out back to a daily time frame, weekly time frame, for you to see that. Okay. Now imagine all I was just showing you was just played out for 1, 2, 3, 4, just 4 weeks of trading. Can you imagine? Just 4 weeks of trading. Now, this was not even a concrete move when the main move happened. Now, see the main move, and let's count the differences between the weeks. That this was 4 weeks, and we eventually started turning around here. I mean, imagine you didn't take your profit all the way here. Bro, you're fucked. I'm telling you, because the market start reversing, and now you lose a lot of money, and I'm wondering, you put yourself in a position whether to take your profit or not. Now your greed, your fear, they're all coming into play. Now you're locked in, bro. You're at the mercy of the market. You're literally fucked in the face, and like, well, most people might be too greedy and just say, I'll let my trade play out, and eventually you lose all that money. But like, I mean, compare it to catching this move. The main move is what I'm saying. I mean, let's count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 18, 19, 20, 21, 22. That's 22 weeks of trading. Bro, that is 22 weeks of trading. But that's like 5.5 months of a move. As I'm saying, 6 months, potential 6-month trade. That's the easiest thing that you can do in this market. I don't care about your other tools. Yes, there are other tools. They all fucking work. People have ways they trade them. There's volume footprints. There's RSI. There are so many tools in the market. But I'm going to tell you, this is by far the simplest and the most important tool to use in the market. Without wasting any of your time, I think I spoke a lot about Euro USD. Let me go to a more trending market, because I just literally gave you a Fibonacci move in a ranging market that played out already. Let me look for a very good trending market for you, and the trade just plays out like it's nothing. I mean, imagine you're catching all of these straight to the upside. Now, I've not spoken about the take profits. I'm just speaking about the entry. Most times I like to take my profit at the Fibonacci extension. But then if I'm using the Fibonacci against the trend, I already understand that my trade is 50-50. It's a 50-50 chance that the trade is going to play out. But if I'm placing it alongside with the trend, now that's a 80-20 ratio for me to win. That's my probability. My chances of winning has increased to 80. It's no more 50-50. Now I'm not guessing. It's not a gamble. It's not a lock. It's not lock. Do you get me? Another trending market. Sporadical trending markets. Let me go to weekly time frame. I'm doing it with the trend and the trend only. I can keep showing you. I'll show you 2 Fibonacci in this region, showing you how they work. This was the lowest point in the market to the highest point in the market. Fibonacci 1. Let me show you another Fibonacci. Low points. This was the lowest point before this market gave a move. This is another Fibonacci. This is Fibonacci 2. I don't know. I feel like now this is the lowest point in the market before the market moved. Now from year to year, this is Fibonacci 3. This is why this market is still buying till now. With the constant buying of a trending market that pulls into a Fibonacci retracement, a discount price where I can buy cheaper and hold my trade for longer. I think that explains it very well. You have price moving up, then the price comes to a discount or a premium region for you to be able to benefit. I mean, it's very simple. Market pulls back. It gives us an impulsive move, did many rejection from here, and pulls back here. I mean, from here to 100% retracement is all you need. But like, if the market is still going crazy, we can have some potential breakouts, retest, and continuation to the upside. But I mean, this is on the weekly time frame. This is 4 weeks of. This is 1, 2, 3, 4, 5, 6, 7, 8, 9. That's 9 weeks of buying. 10 weeks of buying, that's like 3 months. That's what I keep trying to explain to you. 3 months of buy position, that's bro. Well, I could keep going on and keep talking about how Fibonacci works and all of that and all of that. But like, I hope you're able to understand how to use it. Do not use it against the trend. Use it with the trend, but in confluence with a chart pattern in the Fibonacci region. After an impulsive move, you also need a structure like, pattern that is showing you that, okay, these markets can definitely come to this point of interest where I would like to buy from. And finally, you need an engulfing candle from your Fibonacci before you place any trade. Yeah, that's it. That's my time, and I hope you know what to do. Oops.